A lot of people ask me about trading. I'm not a great trader. I've become better over time after making lots of mistakes. But I think that I can give you some insights into how I think about trading. So when I think about trading, I kind of try to balance two things, which is my internal rate of return or annualized rate of return, which is just what it sounds like. And the idea there is that you're treating your capital deployed, your actual capital at work, as your assets under management, or what you're focused on, as opposed to your total capital base, which is kind of what the more practical thing to look at is, right? But a lot of venture capital and private equity funds think more about IRR than they think about so-called cash on cash. And there are two ways to look at the same thing, but if you have cash, obviously that money isn't at risk. So basically the dumbed down way to think about it is, let's say for the entire year you were half invested in stocks and the other half in cash. If you made 10% in the year, your IRR is actually closer to maybe 20%, because if you're fully invested with all of your cash, that would be your sort of unleveraged return, if that makes sense. So, or your annualized return, or IRR. So you have to sort of think about, you know, if you're not deploying cash, you're really not risking that part of your portfolio, if that makes sense. So anyway, and when I say I try to balance IRR with probability, I'm really talking about probability of the trade continuing to go in one's favor, and we'll talk about that in a little bit. Probably one of the best insights I ever had in my life was the idea that if you could catch 5% in a month in a stock, that's as good as 80% in a year. And it seems to me like it's a lot easier to predict a stock will go up or down 5% in a month than the stock will go up 80% in a year. That makes a lot of sense, right? And in fact, it's probably easier than even a 50% move in a stock. So if a stock is up 5%, let's say, because you think the market's misinterpreting some news, you might even be able to get 5% in a week in a stock if you're smart about when you make that trade. And that's why people like to do trades like that. But you also have to think about you know, the fact that you still need to make great cash returns. So even if you make, let's say, 1% in a day, and you get to do that 5 times a year, you're probably not going to make enough money that it'll really matter on a cash basis. On an absolute basis, you're making like, you know, a zillion % IRR because you're only risking your money for a day. But, you know, that's not a practically sort of relevant thing. So you're asking if 5% a month should be 60% annualized, because 5 times 12 is 60, but that's actually not the case, because if you did 1.05 to the 12th power minus 1, you have 79.6%, which is 80%. So you're not compounding the 5%. So you make 5% a month, but you're making 5% every month. So 1.05 times 1.05 is a little bit more than 10%. It's actually 10.025. And then another 1.05%, you're actually at 1.16. So you start to compound, and obviously the effect gets bigger and bigger each month. So after 5 months, you're at almost 28%. So that's sort of how that works. Anyway, so here's a practical example. The portfolio bought Omeros, and it's up 54% in 17 days. This is a pretty incredible outcome. And sometimes this happens, you know, it's luck in some ways, right? And I have a software I wrote that calculates it automatically. It's a 1,000,000% annualized return. Obviously, no one can make that kind of pace consistently. It's almost impossible. But it does tell you about the power of compounding, and it tells you about how important speed is in investing, and it sort of tells you why quantitative investing works really well. You might ask yourself why quantitative investing is so impressive and why it's so relevant, and it is about taking small moves and making sure that they happen in a short period of time. And if that's 1,000,000% annualized return, obviously, you know, a 10 or 20 basis points a day, say 20 basis points a day, there's 250 trading days a year. That's a 65% annualized return. 20 basis points doesn't sound like a lot. It's a fifth of 1%. But if you have a program that can make 20 basis points a day, you'd have one of the greatest hedge funds, probably the greatest hedge fund of all time, which is really kind of interesting if you think about it. So what do you do with something like Amros? Do you sell as fast as you can and lock in this crazy gain that you've had? And so I try not to look at the past IRR, because the past sort of happened, and I can quote unquote lock in this game, but I wouldn't believe in the term lock in. I think that's something that could trick you into making a bad move. The question is, what's the future IRR? The stock's at 24 bucks. I think it might be going to 50, and I think most of my arbitrages, or stock picks, if you will, typically take about a year before they converge on my target price. So the question is, that's 100% IRR, right? About a double in a year is about 100% annualized. Sometimes they take longer, though. They can take 2 years, and sometimes I'm just wrong, and I have to think about the probability of that. So basically, I have to start to calculate and adjust, what's the probability I'm wrong? Where does the stock go? Could it go to $1? And I got to factor in, is that a 60-40? In the long run, my hit rate is usually about 63 or 65%. So I have to sort of think about, what's the probability that I'm right? What's the probability that I'm wrong? What's my IRR if I'm right? What's my IRR if I'm wrong? And I'll have to think about that. And once it becomes unfavorable, I should exit the trade. I shouldn't exit the trade just because I made a lot of money. I think that's a little bit silly. But let me take you to my next example, which sort of connects. I don't have too many rules in investing, but this is one rule that I think served me really, really well. If you capture 50 to 70% of your intended move quickly, so in other words, I thought that Amros would go from 10 to 50, and it's gone from 10 to 24, which is great, or 15 to 24. But if I think it's going to go from 15 to 50, I've only captured, 20 or 30% of the move. So I'm not quite ready to take profits. But if it got to, say, $40 or $35, I think I'd be ready, because I have mostly gotten what I was looking for. And you should never be upset about taking your profits a little early if you've gotten most of your move. Some people say there's a big adage on Wall Street where people say, no one's gone broke taking a profit. And I don't think that's true. I think you can go broke taking profits. I could probably prove it to you. If you constantly sell all of your stocks as soon as the profits start, all you'll be left with is your losing positions, which you'll never sell, and you'll hold on to, and eventually you'll go broke. So that old saying, nobody's gone broke taking a profit, is ridiculous. But I do think if you're greedy and you need 100% of your target price, say if you buy Amros at 15 and you think it's going to go to 50 and you wait for 50 instead of selling it at 47 or 48, I think that's a little crazy, and you should try to just get out when you can. There's a reasonable chance you'll be wrong. There's a good chance you'll be wrong about the exact move, the timing. Nobody can be that accurate. And the faster the stock goes up, the more room you should have. Like if Amros went from 15 to, say, 30, let's see, it could hit 30, who knows, in the next few days. I'd probably just get out. I've gotten half of what I was looking for very fast. But if it's taken less time, I can wait a little bit longer. So it's all about the IRR, and you have to make some of your own points on this. But I think there's something to think about.